All right, let's look at some more information related to our first chapter. Let's talk about financial information up here, and it says to be useful, financial information should be. Well, it should be what? Choice A says relevant and perfectly accurate. Well, financial information, in order to be useful, does need to be relevant, but it does not have to be perfectly accurate. Instead, if you recall from our presentation, if you watched that, we said that financial information, in order to be useful, needs to be faithfully represented or faithfully presented. So it doesn't have to be completely accurate, but it needs to be accurate enough that a user can make an informed decision. And it does need to be relevant. So choice B is going to be the correct answer. I want to bring up one little thing here. Timeliness, in order to be useful, timeliness becomes a part of relevance here. You know, we said that the objective of financial accounting was to present data that is relevant and to do so in a timely manner. But when we're actually going to use it, we're saying that part of this relevance is, or we would say timeliness is included in the relevance portion here. Okay? Let's move on to the second question. It says the monetary unit assumption requires that economic data be recorded in, let's see, in a way that assumes the business will continue operations. This is actually the going concern assumption here, not the monetary unit assumption. In the currency in the home country of the company, yes, that is correct. So if we have a company that's based in the United States, their financial statements will be presented in US dollars. If we have a company which is based in one of the European countries that uses the euro, those financial statements will be presented in euros, okay? Not in dollars or any other type of currency. So let's go ahead and circle choice B. All right. Third question here. It says, what limits the economic data in financial reports to that, let's see here, to that data or that which is directly related to the activities of the business? Okay, well, we've already talked about the monetary unit assumption. Time period assumption, well, the assumption there is that the figures within the financial statements or the financial reports relate to a given period. So that's not really what we have here at all. However, business entity assumption. The business entity assumption limits the economic data in the financial reports to that data directly related to the activities of the business. In other words, no personal funds or debts are included. Business entity assumption is the correct answer. All right, let's move on. The measurement principle requires that, let's see what we have here. Measurement principle. Business transactions be consistent with the objectives of the entity. Probably a good idea, but that's not the measurement principle. Choice B, the Financial Accounting Standards Board be fair and unbiased in its deliberations over new accounting standards. Great statement. It's just that it has nothing to do with the measurement principle. Accounting principles meet the objectives of the Securities and Exchange Commission. That is not part of the measurement principle at all. So that leaves only choice D. The measurement principle requires that amounts recorded in the financial statements be based on independently verifiable evidence. So if we say that we have a building that we paid $200,000 for, a third party should be able to come in and use our backup source documentation and prove that building is worth whatever we say it is. Okay, that's what we're talking about when we talk about the measurement principle. Okay. This next question here, it says the what is the basis for entering the purchase price into the accounting records. Okay, we're going to talk about the matching principle, and we're also going to talk about the expense recognition principle, but I can tell you that neither one of these is related to the purchase price that's going to be entered into accounting records. That's something else. The measurement principle is the verification of the purchase price entered into the accounting records. It is not the basis for entering the purchase price, however, so choice C is wrong. Choice D is correct. So we're going to use the historical cost principle as a basis for entering the purchase price into the accounting records, and then later we will use the measurement principle, or a third party would use the measurement principle to verify that the amount that we have recorded is in fact correct. Let's see here. Looks like we have a couple more questions. Which of the following items is based on the accrual basis of accounting? Revenue, choice A says revenue is earned only when money is received. If we're going to say that, that is the cash basis, okay, of accounting, not the accrual basis. So that's a wrong answer. B, the revenue recognition principle, I will tell you that that is the correct answer. And the revenue recognition principle states that revenue is recorded when, keyword, earned. Okay, so when we talk about revenues in accounting for using the accrual basis, we are talking about recording revenues when they are earned. Okay, choice C looks like that's just a jumbled up mess. We just took the accounting equation and jumbled it all around. And then D, the income statement. We're going to have an income statement regardless of whether we're using the accrual basis of accounting or the cash basis, so that would not be a correct answer. In fact, that's kind of a ridiculous answer. You may not know that yet, but trust me, it is. And then finally, it says right here, the last question, it says the expense recognition principle is also known as what? Okay. I want to start from the bottom because the expense recognition principle states that we're going to record expenses in the period in which the corresponding revenue is earned. Okay, so if we know that we're going to record revenue when it's earned, we're going to recognize expenses when they are incurred. So the expense recognition principle is a part of the accrual basis of accounting. That's choice D. But it is not known as the accrual basis of accounting. It is merely a part of it. So that's why choice D is wrong. Matching theory is just something I made up. Choice B, the accounting equation. Well, expenses are recognized on the income statement. The accounting equation is a balance sheet formula, so that should clue us in that that's wrong. However, the matching principle and the expense recognition principle are synonyms, and I've already told you what that is, but the matching principle just merely states that we're going to match expenses to the same period of time in which the corresponding, jump up to this question, revenue was earned. So we're matching revenues and expenses. These are both income statement items. All right, so our correct answer for the last question, A. All right, we're going to finish this video up and we're going to start another one immediately.